Very good morning, students. Our session of financial management. Now, today we are going to start our last unit and last chapter. That is cost of capital. Basically, this is the 8th chapter of our syllabus, but actually, it is the first chapter of our unit number 1. Unit number 4. Again, cost of capital is the chapter of practical, in which we are going to calculate the cost of different sources through which we are going to raise our capital. So let's start with it. The points that we are going to study is introduction of cost of capital, then after meaning, the third one is features, then after significance, then after concept, then after specific cost of capital, and the next one is practicals of cost of capital. First and foremostly, cost of capital. As we know that company is going to raise their capital through different sources. Some sources are external and some are internal. In external source, company use the source to raise their capital is equity capital. Equity is there, preference is there, and debentures are there. And in internal source, there is a single source, that is retained earning. When company is going to select any option or any source to raise their capital, they are going to bear some kinds of cost for raising such capital, and that cost is known as cost of capital. In a simple term, I am again repeating, કંપની જ્યારે કોઈ પણ સોર્સ થ્રુ પોતાના કેપિટલને રેઇઝ કરે છે, પછી એ ઇક્વિટી હોય, પ્રેફરન્સ શેર્સ હોય, ડિબેન્ચર્સ હોય કે રિટેન્ડ અર્નિંગ, એટલે પોતાના જ પ્રોફિટને પોતાની જ ઓર્ગેનાઇઝેશનમાં રીયુઝ કરવો. કોઈ પણ સોર્સનો યુઝ કરવા માટે કંપનીએ મિનિમમ કોસ્ટ બેર કરવી પડે છે. Or we can say that cost without bearing cost, the company is not able to raise their capital. કેપિટલ તમે રેઇઝ ન કરી શકો જ્યાં સુધી તમે કોસ્ટ બેર નથી કરતા ત્યાં સુધી. So let's discuss about the introduction. It is really very easy one. Theory part is also easy and the sums are also easy one. The cost of capital is a very important factor to be considered in deciding the firm's capital structure. It is one of the basis of theory of financial management. Cost of capital is, to a certain extent, debatable aspect of financial management. Before determining the capital structure, a company is required to compute the cost of capital of various sources of finance and compare them. Yes, definitely. કંપની જ્યારે પોતાનું ફિનાન્શિયલ સ્ટ્રક્ચર પ્રિપેર કરે છે, એટ ધેટ ટાઈમ it is highly required to calculate the cost of capital, because જે સોર્સમાં મિનિમમ કોસ્ટ કંપની બેર કરે છે એ સોર્સ થ્રુ ઓર્ગેનાઇઝેશન કેપિટલને રેઝ કરશે. એટલે કંપનીના કેપિટલ સ્ટ્રક્ચરમાં આપણે એવા ઓપ્શન્સને ઇન્ક્લુડ નહીં કરીએ કે જેમાં હાયેસ્ટ કોસ્ટ ઇન્વોલ્વડ હોય. જનરલી કંપની એ જ સોર્સ પ્રિફર કરશે કે જે સોર્સમાં કોસ્ટ મિનિમમ હોય એન્ડ દે આર એબલ ટુ ગેટ ધ મેક્સિમમ રિટર્ન. So this is the introduction. Now let's see the meaning, that is the definition of cost of capital. The first definition is cost of capital is the minimum acceptable rate of return on new investments made by the firm from the viewpoint of creditors and investors in the firm's security. Definitely we are going to think about our creditors and investors, because if the cost of capital is really very high, then it is very difficult to attract investors for the investment purpose. And when we are going to pay to our creditors, at that time if return is as it is and if company is going to bear the heavy cost, then it is very difficult to make a proper payments to our creditors. Then after, the second definition is cost of capital is the rate of return which a firm requires from an investment in order it increase the value of the firm in the marketplace. Definitely, with the help of cost of capital, company is able to create a proper place in the market, because if the capital structure is so sound, then definitely through that the company is able to create a good image, a good concept of wealth maximization in the market. So it's about the meaning of cost of capital. Now let's see the features of cost of capital. The first one, that it refers to the burden. Definitely, through cost of capital we come to know about that how it is burdensome to raise capital of organization through a specific source. Suppose cost of equity is really very high and cost of debenture is really very low. So at that time company is going to feel that it is better to raise capital through debentures rather than equity, because cost of equity is really very high and company feels a burdensome to bear the maximum cost for raising such additional capital. Second one, it is a rate of return. Definitely, cost of capital shows the rate of return in a proper manner, because whatever capital is going to be raised by the company, that will give a return in a near future. So, on the basis of current cost, the company is going to calculate the future earning. So, if the cost of capital is high, but the return in a near future is, if really very high, then company definitely bear that heavy cost for the shortest period of time, because company knows that in a near future, through this particular capital, company is able to earn maximum return or maximum profit through this source only. Then after, third one, indicate the minimum rate of return. Through cost of capital, company comes to know about that how the new investment is going to give a return on them. If the rate of return is really very high, or if the rate of return is low, then company is going to switch over from one alternative to another one. So, through the analysis of cost of capital, company is able, or company comes to know about how the particular investment or how the particular cost is going to be useful in the near future. Then after, decision on new investment. It is really very helpful to take the decision on the new investment. If a company want to make an investment, then definitely they must have a proper source of capital with them. And if the particular capital is available with the minimum cost, then definitely organization is able to make the new investment with the 100% capitalization nature. So, through a simple calculation of cost of capital, the company is able to get the maximum benefits. Then after, the next one is significance, or in another way we can say that the importance of cost of capital. Now, in significance, the first one is capital budgeting decision. When company is going to prepare the capital budget, that how much capital is going to be required in a near future, what are their source of income, how they are going to utilize their income, if that part is clear, then company can easily raise their capital. And in a capital budgeting, company is going to select those source or those avenue in which the cost will be minimum and the company is able to get the maximum return. So, cost of capital is really very important, or it is really very vital decision when the company is preparing the capital budgeting, because if the capital which the company is going to use in their capital structure that consists the heavy cost, then definitely they are not able to gain the maximum return on it. So, the first one is capital budgeting decision. Then after, the second one, that is the maintaining market value of share. Here the company is going to see that how the new decision that company is going to take to raise their capital affects the market value of the share. If the option which is selected by the company to raise their capital is very costly one, then definitely overall earning of the company will be down. And if overall return or overall income of the company will go down, then company is not able to provide a proper dividend to their shareholders. And if the shareholders are not satisfied with the new capital decision, then definitely the market value of the shares will affect negatively. The third one is designing capital structure. Yes, capital budgeting and capital structure both are interrelated to each other. When we are thinking about the capital budgeting, then definitely we are preparing capital structure on another way. So definitely in the design of capital structure, the cost of capital will helpful, because company is going to select those capital which yield the minimum cost and give the maximum return. Then after fourth one, that is issue of new security. Yes, definitely when the company want to issue the new security in the market, then definitely they need to think about the cost which they are going to think about the cost which they are going to bear in a near future. So when the company is going to raise the new security, then definitely they are going to see that how the capital is going to be raised and what cost that the company is going to bear for raising the new securities. Then after, fifth one is financial decision. Yes, it is really very important to take long term and short term financial decision when company want to introduce any new financial plan, or if the company want to discontinue with the current financial policy. Then first and foremostly they are going to see that how the cost is going to affect, and if the result of their financial decision on the cost of capital is direct, then definitely they are going to take the necessary steps. So that's all about the significance of cost of capital. Then after, the next point is concepts of cost of capital. Now in the concepts we are going to have the different kinds of cost that the company is going to bear, and they are of 5 types. The first one is future cost and historical cost. The name itself suggests future cost means the cost which the company will bear in a near future. and historical cost, that is the past cost that the company already paid for the specific investment purpose or for the specific capital purpose. The second one, that is specific cost and combined cost. Specific cost means when the company is specifying the cost on the basis of different alternatives, on the basis of different sources. So that cost is known as specific cost. Specific cost, like example, if the cost of equity, the cost of debenture, the cost of preference. So that will be known as specific cost. And then after, the combined cost. Combined cost means overall cost of capital that includes each and every source through which the company is going to raise the capital. Cost of capital is the example of combined cost, while cost of equity, that is the example of specific cost. Then after, average and marginal. Yes, we already know that when the average is going to be calculated, that the total cost is divided by total number of inputs or output. That cost is known as average cost. And the next one is marginal cost. Marginal cost is a cost of difference. Means if the company is going to raise an additional unit, or if the company is producing an additional unit, then whatever additional cost the company is going to bear, so that cost is known as marginal cost. Explicit cost. It is a cost of discount that the company offers to their investors. Suppose if the discount is going to be offered for the investment purpose, then whatever additional cost company is going to be bear, that cost is known as explicit cost. Then after, second one is implicit cost. Implicit cost is the cost of opportunity. Means the option which is not going to be selected by the company, then the return on that investment, that cost is known as implicit cost. And then after, spot cost and normalized cost. Spot cost means the current cost or the cost which the company is going to be paid on the basis of the market price. So current cost is also known as spot cost. And then after, normalized cost. Normalized cost is also known as the general cost. And in general cost, the overall cost is going to be divided by the total numbers of unit that the company is going to be, or the company is producing right now. So that's all about the theory aspect of our unit number 4, that is cost of capital. In the next session, we are going to start our practical sums. But before that, there is an explanation of the formula of different cost. Thank you, students, for today's session. Thank you so much.